It's unbelievable what the so-called gurus of the financial world have created. Highly educated Dr. Frankensteins have designed derivatives so complex that absolutely nobody knows what they entail. But in the financial world, that's completely insignificant. Just like I heard with my own ears, it's not what you sell as long as you sell it. The financial salesmen are always looking for profit, even if that means it comes at the expense of the average person. But sadly, people won't even know what happened until it's already over and done with. You came here for the truth, so let me unveil that for you. Today we're going to look at an issue that continues to plague the financial system. We're talking about derivatives, and we're talking about what happens on the inside of these financial companies. I do want to pay particular attention to what we had last time around, but remind everybody that the conditions that led to the financial crisis do not need to occur again for there to be another crisis. That is so important because you have people with their blinders on. They remember the subprime crisis and they think to themselves, as long as those factors don't add up, everything is going to be fine. Remember what occurred last time around. 2007 and even into 2008, they were telling us that there wasn't anything wrong. In 2007, they were saying subprime crisis was such a small factor, there's no need to worry. This will never ever bring down the financial system. Looking back on it a few years later, it seems rather obvious. Everyone said, oh, well, obviously that was the case. Obviously subprime was really dangerous, but now the financial system is a lot safer. But ask the same question in 2007 and you get a completely different understanding. So as far as I'm concerned, we won't realize what happened until after the events have already taken place. So in my opinion, we cannot trust anybody and the information they bring up. We always have to protect ourselves. Let's take a look at this. Now, the major corporations out there made big mistakes leading up to 2008. That was very clear. Today, we have a similar pattern forming, and although they try to whitewash this, although they try to tell you that there aren't these concerns, I have brought up so many different indicators over the last few years that show you, in fact, while we might not be heading in the exact same pathway we did last time, the risk-taking that is being taken today far exceeds what happened in previous instances. No, it might not be subprime crisis fiasco situation that we encounter. It might come from a completely different area, but certainly the risk taking is there and it grows every single day. Remember, all of the debt that you see is somehow tied to a derivative product. All of it. And the debt has expanded tremendously over the last decade. Banks warmed to mortgage bonds that burned them in 2008. Citigroup, Goldman Sachs, and Wells Fargo are getting back into the business. And why? Because right now you have negative interest rates around the world. You have very low interest rates. You don't have a lot of assets that can give you the return. So what do? They're going into something that, number one, they have experience dealing with, but they feel confident that there isn't much risk here because the levels are so much lower. There's not as many players. So now is a good time to have a little bit of exposure to the bonds that ruined it all. Banks are getting back into the business of building mortgage bonds, laying the groundwork for a market that stands to grow as the government is trying to reduce their role in housing finance. I don't believe that for a second. Look at what they did last time around. They put literally trillions of dollars onto the backs of the taxpayers, and surely they will do it again. Citigroup, Goldman Sachs, Wells Fargo, JP Morgan over the past year have restarted or expanded the business of spinning fresh pools of mortgages into securities. Mortgage originations by investment type annually. This is just giving you the breakdown, how this has been over the years since what looks like 2001 up until today, just to give you an idea of the makeup here. They are still expanding. Do not be fooled by what they have told you about derivative products. The CLOs replaced the CDOs that we had last time. They're expanding way beyond what we have ever seen before. Corporate debt is an an absolute disaster right now at this time. And yet, time after time after time, we keep hearing, don't worry, it's not going to happen again. Look, I don't know what's going to happen. I don't know what's going to be the catalyst or the trigger, but I can tell you that all of these corporations are taking way too much risk, and they do it over and over and over again. There is a glimmer of hope here, and I wanted to mention it. What is different now is that the banks are also stepping into the role of buying loans from the third parties and underwriting the securities they piece together. This more closely resembles the pre-crisis days when banks would bid on loans that were up for sale by the lenders that made them. There's more detail in here, of course, but I think it's important to see that all of these financial companies have one thing in mind, and that's profit. If they're not going to be able to get it because they're buying negative yielding mortgage yielding sovereign bonds, what are they going to do? Well, they have to take more risk, and that's exactly what's happening in so many different avenues. There's more in the article here. If you're interested, I will have the links in the description. I just want to move on here. So there's the obvious issue that we've had with these mortgage bonds. They are a lot smaller than last time around. That's pretty obvious, but there's always something new being created. The CLO, while it isn't necessarily new, has grown from its infancy and is now expanding to a level that exceeds the CDOs. CDOs were a big problem back during the subprime and financial crisis. Today, we have the collateralized loan obligations. As far as I'm concerned, it's all the same garbage. There are two people I'm sure you're aware of. We have Michael Burry and we have Steve Eisman from The Big Short. I wanted to bring these up because it's very relevant for this video. This is Michael Burry, and essentially I've already covered this before. We're talking about the issues that are present related to ETFs. Okay, the ETFs are in fact an issue, and last time around, let's say 2007, 2008 timeframe, ETFs were such a small part of the market. Now, I've just read the statistics that already passive investments have surpassed active. Nobody knows what will happen when everybody starts to rush for the exits. The liquidity will drop off. Of course, that is a huge problem. Michael Burry is saying this is where the bubble is. You can disagree, you can agree. I'm just bringing you the information. Then there's this interview here with Steve Eisman. At the very end of the interview, he said something interesting. And this is why most people, they never wait to the end. If you look at the audience retention for any video, every second it goes down and down and down and down. People who do not have the attention span won't get the best part of this interview. At the end, he's asking the question, if right now the problems that we have are essentially too much production, too much capacity, excesses of everything of all types, reducing interest rates is simply not going to fix it. That's not our problem right now. We're not dealing with a sense of needing stimulus. There's already so much stimulus there. So he makes a really, really good point. Some people will say, oh, Steve Eisman this, Steve Eisman that. Doesn't really matter. It could have been a gentleman off the street. I really don't care. The point he's making is extremely accurate in this case. I just wanted to show you some of the excesses that we are seeing today and the desperation as a result. This happens to be one of those desperate attempts for these developers to entice buyers. In this case here, for every house you buy, they're going to give you a Tesla. That's what they're trying to do to get people in. This is in Vancouver specifically, and I just think that this is when you have an issue that you're dealing with. You can't sell the units. You got to come up with all sorts of gimmicks. If you see some of these high-end homes, they throw these lavish parties, they go crazy with these things, they offer incentives, and this happens to be one more of those. Right now, there's an interesting statistic brought to you by Redfin, and essentially, when you're going back and forth between different buyers and you are trying to essentially negotiate, one is trying to outbid the other, well, in this case here, gone are the days where every buyer is having to fight for that purchase. This is the chart that shows you a comparison on a national level: Seattle, San Jose, and San Francisco. All of these have moved down significantly. You can look at the details if you're interested in that. This is talking about the particular states that are encountering hardship and the others that are doing much better. So when you look at it on a state level, it gives you a different idea than if you say the nation as a whole. And I would like to see it broken down even further. That would be great because, if you take California, for instance, you're going to have areas that are doing very well and then others that are really dealing with some hardship. But at least at the state level, we can get a better idea, because if I'm going to point out some facts, somebody might say, well, where I live, that's not the case at all. I'm seeing there's signs everywhere, jobs, business hiring, it's fantastic. Money falls from the sky here. We don't have asphalt. We walk down the yellow brick road and so on. I mean, I've heard all those stories. It's fantastic. But let's take a look. The states that show the highest probability for weak economic fundamentals and are thus at a higher risk of recession are Michigan, Hawaii, and Montana. At 59%, the chance that Michigan will have weak economic fundamentals in the fourth quarter is the highest in the nation. In the bottom paragraph, the states that show the lowest probability for weak economic fundamentals and are thus at a lower risk of recession are Nebraska, Oregon, and Idaho. There's much more in here. If you're interested on looking at the actual details, it lists them all, gives you some statistics about each of the states, then definitely check this one out. Lendingtree.com has the data for you. There will be a link in the description. This is where, they actually pull the data from, and this is coincident economic activity for, in this case, Michigan. I just wanted to show you a repeating pattern that when it starts to turn over in the way it does, generally a recession follows. This happens to be Michigan. Perhaps it's a bellwether for the rest of the nation. I don't know in this particular case, but I wanted to show it to you simply because they're pointing in that direction. So if you want to look at this data, do a search for coincident economic activity index 4 and then type in the name of the state. I'm going to end the video there. Went on very long. If you found it informative, hit that thumbs up button. By hitting one button, you are supporting this channel. Thank you very much. If you want to learn how to build a business online, you're not sure where to start, definitely check out my free 100% free step-by-step e-course. It's called the Amazon GPS. I wanted to give people solutions because I've been asked over and over and over again. I created this course. I made it free. Check it out at the AmazonGPS.com. If you want the financial education you were not taught in school, these two books have everything you need: the foundation, history, the asset classes, tax incentives, so much more. Check it out at the link in the description. If you want the audiobook, that's available at themoneygps.com. Wait a second, don't go anywhere. This video is for you. If you haven't watched it already, click on it and I will see you there.